No one can buy a house anymore, but here's who's getting rich. A new trend is emerging as homeownership becomes more and more unattainable for the typical American. Entire neighborhoods are being purchased by billionaires and investment firms. Many people are questioning whether we are seeing a housing bubble or a planned takeover of the real estate sector as a result of these corporate entities raising rents and home prices. Here are 7 key points to understand what's really happening. Number 7. Billionaires and investment firms buying up neighborhoods. The landscape of homeownership has changed significantly as a result of the tendency of billionaires and investment firms buying enormous amounts of residential real estate. By purchasing entire neighborhoods or sizable blocks of single-family houses, big institutional investors like BlackRock, Blackstone, and others have greatly expanded their position in the housing market. They consider real estate to be a reasonably secure and lucrative investment, particularly during difficult economic times or when interest rates are low. These companies have a significant competitive edge over typical purchasers who depend on loans since they frequently buy homes in bulk and pay cash. Due to their substantial financial resources, these businesses are able to outbid the typical consumer and frequently outbid other purchasers. Number 6, dwindling home ownership for average Americans. It gets harder for regular Americans, particularly first-time home buyers, to afford homes as institutional investors buy up more residential real estate. Home prices have skyrocketed in many U.S. regions, surpassing inflation and income growth. Once considered a key element of the American dream, homeownership is now out of reach for many people. Inflationary pressures have caused interest rates to rise, making mortgages even more costly and discouraging prospective purchasers from purchasing. Younger generations are particularly impacted by these developments because they must contend with growing student loan debt, rising living expenses, and restricted access to reasonably priced borrowing. Number 5, rise of institutional investors. Institutional investors, particularly large hedge funds, private equity firms, and real estate investment trusts, have been increasingly focused on the housing market as a reliable source of return. These firms typically have access to vast sums of capital, allowing them to make large-scale investments that individual buyers simply cannot match. By purchasing single-family homes in bulk, these investors are able to capture large swaths of the housing market, transforming real estate from a mostly individual asset into one controlled by a few large entities. For these investors, real estate offers a relatively low-risk, high-return investment with the added benefit of long-term stability. The houses they purchase are typically sold after being renovated for a profit or rented out, which enables these businesses to provide a consistent flow of revenue. Number 4, impact on rent prices. Rents have been significantly impacted by the move toward institutional ownership of single-family residences. These companies frequently raise rents to match or surpass market rates when they buy and repair homes. Many of these investment organizations aim to charge the highest rent for their homes because they are in the business of maximizing returns. As investors take advantage of low supply and high demand, this might result in notable increases in rent, especially in locations with high demand. This is a significant hardship for renters because pay growth has lagged behind rising housing prices, and rent hikes are frequently greater than inflation. Because corporate landlords are more inclined to impose stringent restrictions and put their bottom line ahead of the requirements of their tenants, the increasing number of these businesses has also reduced the freedom available to tenants. Unaffordable rentals can often cause renters to move or live in smaller apartments, which increases homelessness in particular areas. Number 3, is it a housing bubble? A bubble is a market condition in which prices are artificially inflated above their actual value due to speculative buying and demand that is not sustainable over the long run, according to some opponents of the current real estate market. Although the current state of the market may appear to be comparable to that of the 2008 housing catastrophe, there are some significant distinctions. Subprime mortgages and careless lending contributed to an unsustainable housing boom in the middle of the 2000s, which ultimately resulted in a disastrous meltdown. However, a large portion of demand nowadays is driven by institutional investors who often do not rely on hazardous financing. These corporations are less inclined to panic sell when the market cools and tend to consider real estate as a long-term investment rather than a short-term speculative asset. Number 2, corporate ownership and its consequences. There are significant concerns regarding the long-term effects on communities and the housing market overall due to the growing concentration of real estate in the hands of corporate companies. Neighborhood dynamics can be significantly altered when residences are owned by big investment firms rather than private individuals. For starters, these businesses frequently see real estate more as investments than as homes for families. They might enforce stringent rental restrictions or make aggressive rent hikes because they value business more than the welfare of their tenants. Renters may experience instability as a result of having to move frequently because of evictions or rent increases. Furthermore, if most homes are owned by large corporations, there is a fear that fewer people will be able to build generational wealth through home ownership, which would worsen wealth inequality because homeowners have historically used property ownership as a way to build equity over time. Number 1, is this the new normal? Many are wondering if the increasing number of institutional investors in the housing market will lead to the new normal for American real estate. The majority of residential properties may eventually be held by companies and institutional investors rather than individual homeowners if this trend keeps up, because more people would rent from big businesses and fewer would own their homes. This would fundamentally change how the housing market operates. This might eventually result in a situation where real estate is viewed as a financial asset for investors, rather than a way for people to acquire wealth and stability. If this occurs, we may witness a system in which income inequality increases, rents keep rising, and home ownership becomes an increasingly impossible goal for younger generations. Potential remedies have been put out by some, such as stricter laws to restrict institutional ownership or measures to facilitate individual home purchases, but it is unclear if they will be sufficient to stop a significant change in the housing market. The long-term ramifications of this intricate problem will probably rely on how the market develops and how decision makers handle the difficulties presented by institutional investment in residential real estate. If you liked our video, please hit the like button and subscribe to our YouTube channel.